Good morning. Myself Rathish, Chartered Accountant from Kannur. I am doing in this video regarding the resident status of a person under the Income Tax Act. So in the Income Tax Act, a person is defined as individual, Hindu undivided family, company, etc. etc. So taxation of a person depends upon the residence and the non-resident status of a person itself. A resident person is taxable for the whole worldwide income. Whatever the income he has all over the whole world itself, he will be taxable for that person itself. Whereas a non-resident person will be taxable only for this Indian income. That is, whatever the income that is arising in India or income deemed to be arising in India as per Section 9 of the Income Tax Act. Who is a resident person in India under the income tax itself? A person who is a resident should have a physical presence in India in the current year or in the year of the taxation itself. So he should be living in India or she should be in India a particular days. In that way only he will be considered as a resident person. A resident is a person who just stays in India in that year for 182 days. That is 182 days in India continuously or breaking in whatever may the manner. He should be staying in India for 182 days itself. Or he should have been stayed in India for 60 days in that year. That is in the year of he is just considered as a resident person, and for the 365 days for the previous 4 years itself. That is, either he should be 182 days in that current year of the taxability determination, or the another criteria that is taking is 60 days should be there in the year of the taxability criteria, and for the previous 4 years he should be there for 365 days in India. There are persons who is living in India for employment outside India, and there are person who is a member of a crew of a ship itself who is living in India. In that case also, the resident status in the Income Tax Act is considered as 182 days in the year of he is living in India. If he is staying in India for 182 days in the year of his living abroad, he will be considered as a resident. He should have stayed in India for 60 days in India in the year of his living out of India, and for the past 4 years, preceding 4 years, he should have lived in India for 365 days. So in that case also he will be considered as a resident person itself. Then there is another terminology coming as a deemed resident itself. That is, he will be considered as a resident or even if he is not stayed in India or not India. That case, there is another person called a person of Indian origin, PIO, or citizen of India. A person who is just left India for employment or a business purpose or whatever the thing for a long time, and his parents or grandparents was a citizen of India earlier, then he is called as a person of Indian origin, PIO, or citizen of India. In FEMA, it is called as a OCI also. In that case, there is a division of two categories. If the PIO, the person of Indian origin, has a income of less than 15 lakhs, he has stayed in the year of his visit in India for 182 days, then he will be considered as a resident itself. Or if he has an income of more than 15 lakhs and he stays in India for 122 days or more, he will be considered as a resident. So in the case of a person of Indian origin or citizen of India, there is two criteria. Person of Indian origin, then he will be 15 lakhs and less than 15 lakhs. Less than 15 lakhs, he will be 182 days and stayed in India. And more than 15 lakhs, he should have stayed in 120 days. There is another criteria, whether he will stayed in India or not, or whether he has stayed in less than India, less days itself also, he will be considered as a resident. In that case, a person of Indian origin or a citizen of India who just comes to visit in India and has an income of more than 15 lakhs. He has no taxable income or he has no taxability or in the abroad countries itself. He comes in India for any purpose of visit or he just stays for 182 days itself also. He will be considered as a resident itself. So in that case, there is no criteria of the days in which he is staying. He should have a 15 lakhs more than income. He should have no taxability abroad also. In that case, he is considered. Then comes called as a resident, not ordinary resident itself. In the case of resident, not ordinary resident, a person should be a NRE 9 out of the 10 years itself. Or he should have stayed in India for less than 729 days. In that case also, he will be considered as a resident, ordinary resident itself. Other than the above, all that is resident, not ordinary resident, etc., deemed residents, etc., all the persons are considered as a non-resident itself. So in case of a non-resident person, only the income that is arising in India will be taxable. But in case of a resident person, whatever the income in outside India also, that will be taxable under the income tax purview. And there is another thing called as the double taxation avoidance agreement or taxation agreement itself. A double taxation avoidance agreement is just made between India and the other countries. India has a double taxation avoidance with so much of countries itself, including US or United Arab Emirates, Russia, etc. Everything they have, etc. What is the benefit of a double taxation avoidance agreement? Suppose I'm a resident in India, I'm a resident or working in Canada or something other countries, and also a resident status over there also. In both the countries, I will have to pay the tax itself. So to avoid that or to mitigate that, there is an agreement just made between India and the other countries itself. In that case, the Income Tax Act becomes lesser than the double taxation avoidance agreement. That is, if under the Income Tax Act itself, I will be a taxable person in India. Under the Canadian tax itself, I will be a taxable person in Canadian Income Tax Act also. Then the double taxation avoidance agreement overrides the Income Tax Act. That is, if I could benefit that is getting in Canada is more, then I will be taxable in Canada itself only. I will not be taxable in India. Or otherwise, if I am just benefitable in Indian taxation, so I will be taxable in India and not in Canada itself. In that case, the double taxation avoidance agreement. So double taxation avoidance overrides the Income Tax Act. In case India has a double taxation avoidance with a lot of about 60 or 70 countries all over the world itself, and that is done here. Other than the individual, there are other persons also as per the Income Tax Act. A person is called, there is company, Hindu undivided family, partnership firms, etc., etc. So in that case also residence and non-resident status is there. In case of a company, who is considered as a resident company? A resident company is a company which is an Indian company. That is a company which is registered under the Indian Companies Act itself. So all the companies that are registered under Indian Companies Act will be a resident in India itself. Then the other criteria that is called, it is internationally called as a POEM, place of effective management itself. If the place of effective management is in India, then it will be considered as a resident in India. Otherwise, it will be considered to be a non-resident person itself. So a place of effective management means a place where decisions of a company has effectively taken place itself. If the decision of a company has been effectively taken place in India, or some other, that is a registered office in India, they are taking all the annual general meetings and all the decisions in India itself, then the place of effective management will be in India itself. In that case, it will be Indian company itself or a resident company itself. If most of the decisions of the company has been taken abroad or in some of the Arab Emirates itself or UAE or US or something like that, then that place of POEM will be in US itself. In that case, the company will not be a resident company in India. It will be a non-resident company itself. Then another case coming is the partnership firm. In the case of a partnership firm and a LLP, the residence and non-resident status are considered on the basis of the control and effective management. If the control of the affairs of the partnership firm or the LLP is made in India, that is control means there is 50% of the shares or 20% of the shares is in India, or almost all the decisions are taken in India, or all the directors or partners are in India, or majority of the directors or partners are in India, then in that case, the partnership firm will be a resident partnership firm. Otherwise, it will be non-resident person itself. And one more thing is a Hindu undivided family. In the case of a Hindu undivided family, Karta or the person who is just controlling that Hindu undivided family has been in resident in 9 out of the 10 years, or he has been in India for more than 729 days in the previous 7 years itself also. Hindu undivided family will be considered as a resident Hindu undivided family. Otherwise, it will be considered as a non-resident. So for non-resident, only the income that is arising in India will be taxable, and otherwise all the other things will be taxable in India. Thank you for watching this video. This is Rathish signing up. Subscribe our channel. Make your comments for our future videos itself also. Expect my future videos in the recent future. Thank you very much.